Hello, everyone. Welcome to another Georgetown Conversations. Today, we're going to have a real treat. The whole purpose of the Georgetown Conversations is to have masterclasses with some of the smartest people in Asia. The idea is to give all of you a flavor of the oral history of what has happened in Asia over the last 40, 50 years. Thad Beczak is a friend that I have known since I went to Hong Kong. He is, in my view, one of the smartest and wisest person in Hong Kong because he saw the growth of Hong Kong and the Asian markets from his unique perspective. He was chairman of JP Morgan in Hong Kong or for Asia. Then after he stepped down, he spent 7 years with the Kerry Group, including publisher of the South China Morning Post. So he showed his great skills, not only as an investment banker, but also as a manager of a large conglomerate, including publishing. Then, of course, he was chairman of the listing committee of the Hong Kong exchanges, one of the most important roles in approving companies going to be listed on Hong Kong exchanges. From 2005 to 2008, he was chairman of Nomura Asia and vice chairman of China Renaissance, one of the earlier Chinese investment banks based in Hong Kong. And then, of course, he's taken various non-independent, non-executive director roles, including that for the Singapore Exchange. He has taught in finance as an adjunct professor at Hong Kong UST, and was with me on the International Advisory Committee of the China Securities and Regulatory Commission in China. And today, he's chairman of the Hong Kong Forum, a group of people in Hong Kong talking not just about Hong Kong affairs, but about international affairs, particularly focused on Asia. Welcome, Thad.
Thank you, Andrew.
Now, I want to start with a very simple question. You've seen the rise of Hong Kong and then the rise of Asia, including the problems of the Japanese crisis, the Asian crisis, and then of the rise of China. Give us some perspective. When you arrived in Hong Kong with JP Morgan, what was the financial scene that you saw in Asia at that time?
Yes. Well, thank you, Andrew, and your very kind introduction. But I would say I've been lucky rather than good to have these opportunities. But it's been a very, very interesting experience. And as you alluded to, I came in 1982, which it's hard to believe that's 40 years ago. And the Western banks had operations in Asia, but they really were not doing very much. And the reason that they started to grow in the 80s was to recycle petrodollars. And I came out specifically to call on a lot of the governments in the region and do syndicated lending to countries, including Korea, Malaysia, India, Thailand, Indonesia. And so they were syndicated among international banks. They were sold down to smaller banks. And at that time, there was excess liquidity going on. There weren't a lot of corporates in Asia at that time because the Asian families were quite small. So whether it was Korea, Hong Kong, Singapore, or Malaysia, you didn't have a lot of corporates to call on, with a few exceptions. And in Hong Kong, the exceptions were you had some property companies, and you also had shipping companies. But you didn't have real corporates who were building things, making things. Export markets were relatively small at that time. And then you moved into the period, and Andrew, stop me if you want clarification, but then you move into the period of the Asian tigers, where government policy was such that they were encouraging corporates to expand and to compete. And the best example of that was Korea, where in the 80s, I used to spend a lot of time in Korea. I'd go there pretty much every week from Hong Kong. And we were probably doing 20 syndicated transactions a year with Korean entities, with the big group, Samsung, Hyundai, et cetera, and they were quasi-project financings, and they were supported by letters of credit, all kinds of things. But that was really the beginning of what I would say the corporate business in Asia. Now, before I go on and you ask me a follow-up question, the other thing that I would say, there were two other activities that were very important. And those were calling on central banks. And the big US banks were doing a lot of FX and government bond business with the central banks. And the big three at that time were Brunei, Singapore, and Malaysia. And they were very, very profitable accounts for the international banks at that point in time. The last thing I'll make before, again, you ask me the next question or a follow-up, is there was no Chinese business at that time. So I didn't even go into China the first 3-4 years I was in Hong Kong. It hadn't opened up, there wasn't much to do, and so it just wasn't on the radar screen.
Yeah. Well, I just this morning had a great chat with Dr. Michael Chen, who was with the Harvard Business School. He came to Hong Kong with Citibank. And
Yes.
one of the remarks that he made was, well, Hong Kong, Shanghai Bank and Standard Chartered were the banks, right, in those days. But they focused only on, sort of trade finance.
Yes.
Actually, American banks came in and identified a very clear niche, right? So,
Yeah.
as I was in Bank Negara at that time. We didn't have a chance to meet, but I would meet these very smart bankers from JP Morgan who would call on our international department talking about how to raise Malaysia sovereign bonds,
Yes.
as well as investing Malaysia's reserves, right?
Yes.
Which was small at the beginning, but later on grew, quite substantial because of our Malaysia's oil revenue.
Yes.
So, in a sense, you brought in a whole generation of new bankers that later on become chief executives of some of the banks in Asia. So what was so special at that time? It was a really open field for American banks in Asia.
Yeah, well, what I'll say, and carrying on from that, and I think if you use HSBC and Standard Chartered as the examples, they were really very local banks, although they had very big footprints. They were doing a lot of business in local currency. They weren't doing a lot of what I would call cross-border international lending that we know. And although they participated in a lot of these sovereign loans, that wasn't their emphasis. And so they weren't structured to do that. And they had a very different deposit base. For example, HSBC's deposit base in Hong Kong dollars was huge, but they didn't have a natural US dollar deposit base the same way the Cities, the JP Morgans, the Bank of America's had. And I think it again goes back to your next question was really talking about people. And at that stage, the HSBCs and Standard Chartered were not hiring university graduates. They were hiring people out of high schools. HSBC was hiring a lot of Scottish people. And they just came from very different backgrounds. And by the way, for 1 minute, I'm not suggesting that these were inferior people. I think far from it. There were many, many very capable people, but it was just a very, very different emphasis.
That's right. Now, coming back to the 80s, at that time, the biggest investment banker, although they didn't call themselves was Bangkok Bank.
Yes, that's correct.
The Sopapanik family was really very smart, linking up all the tycoons in the Chukongs in Indonesia, the Malaysian businessmen, Singapore businessmen, doing in Philippines, Vietnam,
Yes.
And they were linking up all that business, right? So they had a hugely profitable, kind of somewhat informal finance, but it was very important for these tycoons who were then, really getting into their own, right? But at that point of time, the JP Morgans, the HSBCs didn't get into that business, if I recall correctly.
No, they didn't. And I really think Bangkok Bank's a fascinating story. And there's a book, which I'm sure you've read, Andrew, that Tim Clissold talks about Asian Godfathers,
right,
which was written probably 20 years ago.
Right.
And it talks about the role of Bangkok Bank. And I think they were truly a merchant bank at that time because they always tried to take a piece of the action.
That's right.
But then it started to dissipate. And at the end of the 80s, I think they were just relatively small after that first round.
Right.
And so they become less important. And as the Asian families started to look for other sources of financing. And at that time, I think the big player that took over from Bangkok Bank was HSBC.
That's right. But also at the same time, now we're moving into the early 90s, the late 80s and the early 90s, when the Japanese came into their own. They
Yes.
became big players in Hong Kong, right?
Correct.
They had lots of money to lend.
Correct.
They lent to all the Asian bankers and all the Japanese houses. The Toyotas, the
Yes.
subcontractors, their suppliers, and they effectively help finance the Japanese supply chain in Asia, right?
Correct.
And now at that point of time, what was J.P. Morgan and the American bank's role in that phase?
Well, in theory, the U.S. banks partially did their expansion to call on U.S. corporates abroad.
Right.
But as it turned out, there wasn't a financing need there.
Right.
And so I think what happened was, as you rightly pointed out, the Japanese banks, and particularly in countries like Indonesia and Thailand, which were the two big markets, were doing an enormous amount of financing for Japanese corporates, whether it was resource-based, manufacturing, like autos, companies like Astra and other stuff. But I think it was a problem for the US banks because there wasn't enough business. And so there was this constant evaluation of how did you make money. And there wasn't a lot of interest in lending. So there became much, much more of an interest and emphasis on trading in the 90s.
Right. And that's where, the Citibanks and the JP Morgans brought up people like Frank Wong,
Correct.
Anthony Leung, and all these FX stars, right? I mean,
Yes.
they were big traders in the bond market, and
Correct.
of course, at that particular point of time, you guys also brought in Indian bankers, who again began to play a major role, in that area. So the American banks were the major traders, and then HSBC then realized that if they didn't get into that act, their market share would also, be hurt, and that's why they built the biggest trading room, FX trading room in Hong Kong.
Yes.
Right. And
yes, what I would add to that, Andrew, and I think you've alluded to it, in the 90s, when I went to Japan for a while and then came back, the emphasis was on going local. And so there was an enormous effort to hire locals, whether it was on the trading side or the coverage side. And so what gradually happened is Western expats were moved out. And the HSBCs and Stanchard's did less of this, really, until probably 10 years ago. And so then there was a policy of trying to find Thais, trying to find Malaysians, trying to find Chinese, and they were being done through what I would call Western education. And what it was doing is giving, I think, a different insight into local markets and local players, because many of the locals were very well connected. And it became a very different emphasis of how you were going to do business and work with local clients, however you define that client base.
Right. So so we come back to the fundamentals of banking, which is relational banking.
Yes.
Correct. The HSBCs and the Stanchard's of this world, plus the OCBCs, the Bangkok banks, they had deep relationships with the locals.
Correct.
Correct. Right. And at that particular point of time, the locals were only just beginning to learn about how to do regional business. Correct. So the Japanese banks would lend to a local if he was a major subcontractor supplier, a component
Correct.
factory to a Japanese factory, right?
Yes.
American banks were smarter because they stole the more entrepreneurial clients from the HSBC's Stan Chart as well. Because when the guy was wanting to go into manufacturing something brand new, HSBC and Stan Chart understood real estate, understood plantations, understood mining, but in
Yes.
the manufacturing area, no way. So Dr. Michael Chen was saying how the American banks actually provided liquidity to the newer class of family businesses in the game who was not being served by the traditional banks.
That's correct. And I think the other thing happened at the same time is loosely, and I'm really talking about JP Morgan, but I think this was also true at Citi, is the private banking business meant that you were calling on the wealthy families. And so you got to know them better because you effectively knew if they really had money or not. And if they started a relationship with you on the private banking side, it became easier to have a dialogue with them on any other services, including lending, acquisition finance, providing advisory services, capital markets activity. So it became a cross-fertilization of contacts and knowledge.
And also cluster effect.
Yes.
Because if you had the network throughout Asia, and suddenly one rich guy in Indonesia wanted to do something in Hong Kong, you put the two persons together, and then you finance that deal, and everybody wins, right? That's real investment banking, which the traditional British banks didn't have. They didn't have that knowledge because they weren't even focused on private banking. They were just basically trading banks or corporate banks, but not private banks, right?
Yes, and also at that time, as I think you remember, in the 93, 94, the US banks, I should say, in particular, started derivatives businesses.
Right.
And that was extremely important for effectively managing risk. And it was also used as a way of financing, that you would take equity positions and put a derivatives on them and provide liquidity, as you alluded to. But the most important thing about the derivatives business is you were able to charge spreads way, way in excess of the lending business.
Absolutely. I still remember being the bank regulator. I asked the Citibank guy, how do you make so much money in Malaysia? And the answer was, he was actually using, today I understand it better. At that time, I couldn't understand it. He was packaging loans to his clients and selling them off to other clients with a fat spread.
Yes.
Right? Whereas the traditional bankers didn't understand how to do this. So once they lent to a customer, they were stuck with that customer for 10 years, 20 years, 30 years, right?
Correct.
Whereas Citibank, loaned to this guy for a 7-year loan and sold it to somebody else for a 2-year, the equivalent of a 2-year deposit at a rate better than the deposit rate, but, with very little credit risk, for both sides. And with that volume, if I recall correctly, Citibank was making, at that particular point of time, Malaysia was amongst the top 10. I can't reveal secrets at that time of their money makers, and I didn't understand how it was done. But now I get it after you mentioned this derivatives area. But let me come into the very important area in Asia, which was when the stock markets came into their own.
Mm-hmm.
You recall in the 80s, and towards the end of the 80s and the early 90s, Malaysia was the largest part of the MSCI, emerging markets portfolio, right? And then, of course, thereafter, the others grew, right? I mean, Hong Kong grew, Singapore grew, etc. Now, how, from JP Morgan's perspective, at that particular point of time, what was seen as the opportunity in the stock markets?
Well, that's interesting because if you really look back, the Goldman's and Morgan Stanleys only came to Asia in the mid-90s.
Right.
And they came out with very small presences, 2, 3 people rep offices.
Right.
And then there started to be some acquisitions. And Citibank bought Vickers DaCosta. Merrill Lynch bought Sun Hung Kai Securities.
Right.
And that was I think in 93, 94.
Right.
Vickers might have been a little bit earlier.
Right.
And so the reality is JP Morgan didn't have an equity strategy until the late 90s and really after the Asian financial crisis. We looked at it a number of times. We set up a small equity operation, but we weren't really very active. And we actually looked at buying Barings when Barings got into trouble.
Right.
But the acts in the equity market were really local firms and Wardley's, which was HSBC's subsidiary. Right. But they were nothing like the size that they are today. So you really had local players in all the markets. And it wasn't until you started to get bigger market caps and then global investor interest that the banks really started to expand. And that was after the Asian financial crisis.
Right. So the Asian financial crisis was a hallmark. I mean, it was a watershed in the sense that you clean out some of the bad boys.
Yes.
Not all of them were cleaned out. Some of them, reinvented themselves. They bought back all their debt at 20 cents on the dollar at some of the deals that you and I know, right?
Yes.
Lehman Brothers was right in the thick of this stuff. Okay.
Yes.
Package all the NPLs, sell it back to the original owners, 20 cents on the dollar, and you make a ton of money, right?
Yes.
And for the tycoons who were literally flat on their backs, they came back, and they came back with a vengeance, as we know some of them today. Okay.
Yes. No question.
But after the Asian crisis, the new dragon surfaced, which is China, right? And this
Correct.
was the big market, not just in terms of the SOEs who then came in on the listing, but also the money guys, the Chinese state-owned enterprises, but also the private sector guys started coming into this market, and you were there seeing this. So tell us some of the war stories on that area.
Well, it's interesting because why we started a little equity business was to do China. Right. And that's when you had, Merrill Lynch did the first couple, which was Qingdao Beer, and they did one of the steel companies. I think it was Wuhan Iron or Steel. I forget which one it was. But it was very clear that people were starting to make serious money off of relatively big China listings. And so it then became reactive to say, how do we get into this game?
Right.
And what happened was, and that was true of Goldman, Morgan Stanley, everyone, and Merrill Lynch was the first to do it. But it became very, very tricky in terms of doing due diligence, getting through commitments committee, and what you could or could not do. And so that really took, I would say, from the mid-90s until really 2003, 2004. So it took almost 10 years that it started to be what I would call a real business rather than a niche business. And that's when the Goldmans, Morgan Stanleys, as well as the JP Morgan started to get involved big time. And JP Morgan merged with Chase, who had bought Jardine Fleming. And so effectively an equity business was obtained through merger. And Goldman, Morgan Stanley brought out tons of people, and they did it to service a global investor base. So as you rightly pointed out, it was really from sort of 99 to 2003 when you were in Hong Kong, there was the initial wave of what I would say very large SOE listings in Hong Kong.
That's right.
And it was a game changer, no question.
No question. I mean, even I didn't understand all this stuff, okay? I mean, I saw the opportunity for Hong Kong, but at that particular point of time, I was so engrossed in the demutualization of the Hong Kong Stock Exchange, all the local political infighting over this. What I think Hong Kong people themselves did not see and did not understand was that there were very few local investment banks
Correct.
That could have grabbed that opportunity,
Correct.
right? Let's be very blunt about this. I think the American investment banks, particularly Goldman Sachs and Morgan Stanley, maybe UBS and to some extent Deutsche Bank, were very big players in this field, cultivating the SOEs, etc. Whereas the HSBCs, the local houses, were not so aggressive. The result of which the bulk of that business, investment banking business, was captured by the top, 5 or 6 American and some European investment banks. Am I correct?
I wouldn't have put Deutsche in there because Deutsche became a derivative house. But there's one exception to that. But I really think it was the big three first, which was Merrill Lynch, Goldman, and Morgan Stanley.
Right.
And then later JP Morgan came in.
Right.
But the house you're forgetting that, really was, how do I want to describe it? A meteor or a rocket taking off and then crashing was Peregrine.
Oh, yes. Oh, yes. Yes. No, I had forgotten that. I had forgotten.
Which was Philip Toes and Francis Leung,
right.
who were both ex-Vickers, both Citibank guys.
Right.
And before that, they were Wortley's.
Right.
And I mean, they were really very, very influential for that period of doing big ticket red chip type deals in the late 90s till really about 2000.
Right. Right. But, the story was that they were entrepreneurial, but
Correct.
they didn't take care of risk management and the operations at the back office, right?
Yes.
Whereas the American banks were much stronger because they learned
Yes.
their lessons back home in New York or Chicago or wherever it was.
Yes.
So they flopped because of that. And to
Yes.
some extent, this is another story which we'll have to spend a little bit of time on. Back in the 80s, Phung King Hey, in charge of Sun Hung Kai Finance, had nearly a quarter of Merrill Lynch. I mean, he
Yes.
was that kind of entrepreneurship. Okay.
Yes.
And one tends to forget that with one big leader like that, a whole generation of professionals, Paul Chow, and sort of all these top professionals were graduated from Sun Hung Kai Finance, right?
Yes.
And they influence it. But no Asian then were able to take the business of investment banking in Asia by storm. It was basically the success story was, as you say, the big three.
Well, but there's another interesting thing here, which we tend to forget, is if you really looked at the 90s, the biggest investment bank in the world was Nomura Securities.
Right.
And I think it was in 93, Nomura had a bigger market cap than JP Morgan, Citi, and Morgan Stanley put together.
Right.
And it was because the Japanese equity market was so important.
Right.
And there were a lot of structured deals, covered warrants, and everyone wanted to get into that piece of the action because it was really money for old rope. If
Right.
Nomura was leading a deal, you'd come in, not do anything, and you could make $1 million on a trade. But the interesting thing is what happened to Nomura.
Right.
And it had this enormous advantage, and it did nothing with it because it couldn't break out of the Japanese market, really.
Right. Right.
And its expansion in Asia was again to provide Japanese equities in this boomer bust market to the tycoons, the central banks, et cetera, et cetera. But they really never capitalized.
Right. Right. But if I may sort of interject, the British banking model was 3 by 3, right? 3% spread, lunchtime that takes 3 hours, and then 3 o'clock I'm in the golf course. The Japanese actually copied that model because they had scale. And then, of course, after the Asian financial crisis, they just dropped out. The spread was no longer 3%. It was squeezed down to near zero or negative because their credit, was so bad, right? I mean, a lot of non-performing loans. And then they, I'm sorry to use the word, squandered all their advantages.
Yes.
Now we come to the very exciting period, which is the 2005 to thereafter, which is the rise of China.
Yes.
Now, the interesting point about the Chinese banking system is that the banks are the Chinese banks today are the Japanese banks of the 80s, right? They are humongous in size, humongous in market cap, but not focused on investment banking.
Mhm.
So then the key question becomes, why do you think that the system, even amongst the private Chinese financiers, who were very smart by any standards, never grew to fill that kind of role? I mean, to create the Chinese investment bank, of the 2000s.
I think it's interesting though. I mean, I think something you're alluding to before I answer that is what happened after the Asian financial crisis in '97 is the US banks stopped lending to corporates pretty much throughout the region. And that slack was taken up by the Chinese banks and the Japanese banks.
Right.
So if you look at the group that I worked for, um, basically within a period of 4 or 5 years, 90% of the exposure was from 3 Japanese banks, 3 mainland banks, and HSBC. And the cities, the JP Morgans, the Bank of Americas had given up that thing. Now, therefore, it then gets to your question, which why the Chinese banks didn't do more with this. And I would argue it was 2 things. I think it was really a question, not of, again, talent per se, and that the people weren't capable, but they were set up to do a lending function and not create other products. And so it became very siloed. And the other thing was they didn't have what I would call a real profit motivation of saying, how do we maximize return from our risk that we're putting forward? So they weren't into securitization. They weren't big in derivatives. And so it was, as you said, and the Japanese banks are still this way. It was pretty much we'll lend and we'll keep the position. And I think the Chinese banks are the same. But I do believe, and we're getting to today, or the past 5 years or so, I think the Chinese bank securities companies have become really pretty good. But that's moving on 10 years from where you were talking about.
Right. So if we may kind of sum up the 90s and the first decade of the 2000, the South Koreans, who were amongst the most aggressive and entrepreneurial, they were wiped out by the Asian financial crisis.
Yes, they were.
So the financial system was basically taken over. I mean, they salvaged parts of it, right?
Yes.
But the entrepreneurial part, the market share part, they dropped out.
Yes.
The Japanese, who were the giants, who could have made big changes, they lost their advantage and didn't exploit it when you're height of the market,
Yes.
right? And then they lost the plot afterwards. Okay.
Yes.
The Chinese banks are now the hordes, as it were. They've got size, they've got scale. Okay, but they lack the entrepreneurial part to take into this consideration the strategic market share. Okay.
Yes.
So now the point that you raised, which you and I both quite agree on, but we have not yet seen them emerge significantly, is that the Chinese security houses have begun to play the role of investment banks, particularly for Chinese private sector and SOEs. Correct?
Yes, correct. Well, the other thing that I think is important, this gets back to the Japanese and also now the Chinese. What the US banks did very, very well is they became agnostic to nationality. So you already mentioned that Indians became powerful, Chinese. And so the management teams were very diverse and very international. Nomura tried this with the Lehman team and failed when Jesse Patel, who's still in Singapore, came in after the Asian financial crisis. But both the Japanese and I think the Chinese had real difficulty attracting and treating as equals or allowing local Asians to run operations. And I think that is a critical difference between the successful firms and the not so successful firms. So again, if you're one of the Chinese banks today and you want to do business in Indonesia or Australia or Korea, you have to have locals. And do you have systems and policies and your human resources and compensation that allows you to do this? And I think it's extremely important.
Yeah, you raised a very, very good point about the cultural dimension to this. A very good case in point that you reminded me is Australia.
Yes.
You know, Australia is a big market. I mean, in
Yes.
the 90s, I mean, you know, and even today, Australia is the rich country in the Asia Pacific, and yet Australian banks are very self-satisfied with their domestic market and hardly ever really moved into the Asian market, right? Other than Macquarie.
Yeah. Well, they've tried, but they failed. And you know Mike Smith, and when he went down to
Right.
ANZ, he really tried.
Right.
And it turned out not to be as profitable as he'd hoped, and
Right.
therefore the board then shut it down.
Right. 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 Okay. So now we're what this conversation has led us to think about is that perhaps Asian financial community is not really strategizing. Okay, there is this huge area which we all know is a high growth area, high savings area, right? Because there's still a growth with
Yes.
growth comes savings. Politically, much more stable than, let's say, Latin America, Middle East, or Africa, right? And the governments who are much more attuned to markets and less ideological, all right? But the strange part is, you know, nobody's pulling the finance issues. So you go off on a tangent like Asia bonds development, where there are no spreads to be made on bonds,
Correct.
right? And the Asian stock market are completely fragmented. I mean, you know, so we have no synergy at all, and you know, and therefore, what this conversation tells me is that every country thinks along their national lines without understanding the need for regional development.
Yes.
And so the result is it's taken the Goldman Sachs, the Morgan Stanleys, the JP Morgans of this world who have come in to exploit this. But now the US-China tensions have also created, you know, barriers to such work. Or do you don't see it that way?
No, I agree with that. And but let me just make some notes of what I want to say here. You know, talking about, let's say, from 2000 until a few years ago, all of the big major banks used one or two global consulting firms to advise them.
Right.
And without naming names, because I'm going to be fairly critical, and I was involved with three studies that this firm did for three totally different institutions. They really pushed the idea of cross-selling. And they said, you use your lending business to cross-sell. Now, I think that missed the point of where we are going today and what you're alluding to in terms of markets. And I think that any financial firm, or frankly, any government, has to say, who are your clients and what do they want and what are their needs? And related to that is the fact that historically financial institutions have thought in terms of lending business, lending money, or raising capital, when in fact, the shift that's taken place very dramatically, and the first that I think really saw this is Goldman, is the real emphasis is on investor flows.
That's right.
So servicing the big sovereign wealth funds, the big central banks, and more the wealthy families and private banking networks have become clients. Now, I can go back to JP Morgan when I was leaving at the end of the 90s, early 2000s. No one ever thought of investors as clients. And it's a totally different ballgame today. Now, therefore, when you talk about local markets, local exchanges, whether it's bonds or equities or currencies, there is so much emphasis on what I would call preserving national autonomy and the strength of integrity of local markets. But the problem is none of the markets have scale.
Right.
So you really get into a problem. You can't get liquidity, you can't get scale, you can't get big international players, especially as we go into a digitized world where, again, costs are being taken out.
What is the future then in the new digital finance area? If we were to take your ideas forward?
Well, I think this is the $64,000 question. And I, as you alluded to, I just after 10 years, I had to step down from SGX, Singapore Stock Exchange. And virtually for the last 10 years, Singapore has been thinking about this and trying to identify the opportunity. And there are many facets to it. There's politics, there's scale, there's relationships, et cetera, et cetera. And you know better than I the issues in ASEAN and how you develop something that becomes cross-border. But I think it's fair to say that there's a recognition that what historically has happened with exchanges or bond trading and where we're going today because of blockchain, digitization, it again means the profit and the cost is coming out. And this is being forced by investors, whether it's hedge funds or big ETF players. They're saying we want as little friction as possible, and we don't want to tie up our money in settlement. So to the extent that technology allows us to do that, let's go ahead and do that. So again, I think broker-dealers are being forced to reassess their business model. Exchanges are being forced to reassess their business model. And if you look at the big players in Europe and the US, they all recognize now the value in their franchises and information. It's no longer in platforms, which can easily be duplicated. So you're again evolving into new strategies and new structures.
Yeah, you see, here's the issue, right? If you really look at the Japanese market, which definitely has scale,
yes.
But because of zero interest rates and the idea that you can actually reduce the cost, there's no money in it anymore.
There's no money.
Right? There's no money there, right? I mean, the Japanese have already got the scale, and
Yeah.
a new guy comes in. Where's the profit? The corporations don't care about ROE because they care about employees and they care about the pension fund. So they're not making new money, right?
Yeah.
The rest of Asia, the Koreans are very focused on technology.
Yes.
But it actually is basically Samsung, LG, and a couple of others, right?
Yes.
The Taiwanese market is a very vibrant market, but is very local, other than TSMC, right?
Yes.
So then you go down the line, we've got pockets of liquidity, technology squeezing margin down to zero, and then scale, where there is scale, the ROE is not quite there.
Yeah.
Right? I mean, you would have thought that in China there was huge ROE, and there is. I mean, it's not that there isn't. It's just that it's in pockets, right? So the key question then for the opportunities is really for everybody, not just the consultants. I think when the first sign of big trouble is when they hire the very expensive consultant, as you know.
Yes.
Right? Which what it means is that the board doesn't know what the hell it's doing. That's why you need a consultant. Okay. Whereas the really smart companies are those who hire the consultants to persuade the other board members to agree with the CEO, right? Or whoever's driving that business strategy. So now, coming back now, this is where all the flows are now problematic. Given the fact that global flows may become fractured because the U.S. flow is definitely there because it's the biggest market. The Europeans are essentially a closed market, not easy for others now to penetrate. Okay, and then in Asia, again, different pockets there. How do you see this for the global investment banker?
Well, I think that if you look at it, and this gets back to, I think the issue you've addressed. The problem is that whether it's bond markets or equity markets, they're free float, and actually the liquidity is minimal, with the exception of China and the exception of the big tech companies. So if you look at the trend in the MSCI, which I think is relevant here, is that the MSCI will go up whatever it is now, 6-8% of global market cap to probably 15%. But virtually all of that will be China, the growth.
Right.
And so therefore, again, if you're a big firm, you've got to get your China strategy right.
Right.
And to really start to say, whether it's Australia or Thailand, even India, it's the opportunity isn't there. So it's why you can see now with something that you're aware of, the financial reforms in China, all the big houses want to go in. They're not 100% sure what they're going to do, but they're all taking up new licenses. And part of it is again driven by investor flows and trying to focus on wealth management, putting together structured products to sell through a network, and asset management.
That's right.
So that's where I think the big business opportunity is going to be in the next 10 years.
So Tad, what you're basically saying is that no strategy in Asia can work without a China strategy.
I very much agree with that.
Right? Because,
Yes.
Even if, let's say, my business is, let's say I'm based in Malaysia, I want to do business with Indonesia, I cannot ignore the Indonesia-China strategy, nor can I ignore the Malaysia-Indonesia strategy, because if either one goes wrong, my Indonesia-China business, I mean, my Malaysia-Indonesia business will get affected. Because, even let's take palm oil. Who's the biggest consumer of palm oil? It's China and it's India, right?
Yeah.
So I can't do a Malaysia-Indonesia palm oil business without ignoring what the hell is going on in China. Palm oil consumption, right, or etc. So, therefore, the gist of where our conversation is going is that I don't think this level of conversation on strategy, on big thinking of where things are going, and then the technical details of market liquidity, costs, regulation, technology, if we don't get a grasp of this at the level of policymakers, academic thinkers, business leaders, and the markets, nothing's going to move.
I mean, you're a better judge of that than I am. I do think there are 3 or 4 financial firms that are thinking about this intensely, including the need for technology. And by the way, it's not only Goldman, JP Morgan, Citibank, it's also BlackRock, Blackstone, KKR, Capital. So I think you're talking about a new group of players who see financial services very differently. So it's expanding from the lender and the broker-dealer to a very different pool of participants. And Ant Financial is a good example of that. I don't know what you call Ant Financial. Is it a platform? Is it an intermediary? Is it something different? And so I think we're in a completely different ballgame.
Right. But the point that I really want to make is that the missing picture in this game is where are the regulators? Where are the policy thinkers? Because if they are not on board, the accidents will happen, right?
Yeah.
Right? I mean, the Asian financial crisis happened because I was there as a policymaker, right? I was,
Yes.
the deputy chief executive of the Hong Kong Monetary Authority, and I saw it in the traditional manner: free markets, free flows, follow the IMF, liberalize capital account, everything will be hunky dory, and then boom, somebody ate our lunch, right? I mean, you and I know this, right? And then, of course, Asia's the good news is Asia has been more cautious after that. But now Asia is at the cutting edge because it's now moved up front. And the policymakers don't have a good feel of where the markets are going, the technology is going, the way the cutting edge people are thinking about the problem. And that's an accident waiting to happen.
Again, how do I want to say this? I do think our friends in Singapore understand this, but I think they're almost alone because I think they've been forced to think about it as the nature of their markets has changed.
Right, right.
I think our friends in Beijing probably are starting to understand it.
Okay.
But I'm not convinced our friends in Hong Kong understand it yet.
Very, very good points. Very, very good points. I think if I may be a little bit bold, Singapore may think a lot about this, but being a smaller player, very difficult for them to affect the outcome.
They have a weaker hand to play.
That's right. That's right.
Yeah.
No, but doesn't mean that they won't win, right?
No, I understand. I agree.
But I just want to make this point,
Yes.
But the real players are the ones who actually are going to be at the table.
Yes.
And nowadays, to be at the table, you need big bucks.
Correct.
Either big bucks or big technology, right? Because if you don't have it, nobody's going to talk to you. That's the serious part about it.
Yeah, as you know, technology means that scale. Once you achieve it, it's very hard to lose it.
That's right. That's right.
And so, again, everyone's afraid that Facebook's going to get into finance just because of the scale they have.
That's right.
Now, again, the regulators haven't allowed them in, but clearly in China and elsewhere, I'm sure you saw that Ant Financial has gotten one of the licenses in Singapore.
Right. I won't comment on individual cases because that's.
I know, I understand.
That's my training as a regulator.
Yeah.
But the trends are very interesting. I mean,
yes, they are.
The trends are very interesting, right? Because I think we all understand that politics and finance are very closely tied together.
Correct.
And those people who understand both are going to be the winners. Those people who only understand one side will be the losers, because you just don't see where the risks are coming from and where the accidents are likely to happen. So this is I think, Ted, we're setting up a real masterclass here, because what we really need to do, I think, is to educate more people in Asia to start thinking at a much higher level than at present. Because the lesson that I get talking to various people is that we've trained a lot of very good people, but at silo levels.
Yes, I think that's right.
Connect the dots, right? They can't connect the dots. And if they can't connect the dots, they can't move forward because they're always drilling deeper into the Swiss cheese.
Yes.
Right? And in fact, hollowing out the hole rather than actually making it bigger and better for everybody.
And you try and solve and deal with what were historic issues and problems rather than saying this is where the things are going. So, if you look at something like core location technology, where you can trade nanoseconds and you have an advantage because you're in a core location than a mile away, how do you explain that to a regulator unless they really, really think about it? And so the more digital and the more computer-driven you become, the more AI-driven, the more you risk losing control. And I think most of the big houses today, and you don't need intermediaries for that. An algorithm or a program is not providing information with someone picking up a telephone and calling.
Well, as you know, Tad, my views on this is that a lot of the big finance houses, particularly the banks, they're well covered by the central banks. If I'm in trouble, the central banks print money to bail me out. And the sad part about this is all the non-bank financial intermediaries, which include the mutual funds, are beginning to think the same.
Yeah.
And that is setting up the whole system for a major failure issue. I hope it doesn't happen, but these are the subject of a very, very different conversation. But that, that's been a fabulous discussion. I think it's brought back lots of memories of what happened in the last 30, 40 years. We really need to draw a lot of lessons from this. I think we haven't. And the reason is that the stories that are being told by everybody gets only part of the picture, right? So the Asian financial crisis seen from Japan is very different from the Asian financial crisis seen from America.
Yes.
Right? And the Chinese, who were not victims of the Asian financial crisis, but used it to reform themselves, actually benefited from that painful reforms. But now China is at the cutting edge, or at least in the frontiers of the big markets. They have to figure out how to operate in a very, very new world.
Yes, I agree completely.
So good. So thank you very much for sharing the time, and we'll carry on this conversation, because I think it's fascinating. It will be very educational for our students and our staff, because what we talked about is not in the textbooks. Let's be blunt about it, right?
Well, I think financial teaching has not caught up with what's going on in the markets.
That's right. That's right. So, and I think that's what is needed now, that a new generation of finance students begin to understand that the theory is lagging the practice.
Well, if I could give you one last example of why I think this is so important. And this is talking about the tech companies in the US. As you know, they have huge amounts of data.
Right.
Researchers aren't allowed to have access to that data.
That's right. That's right.
And so how can you study what's going on if you can't see the data? And if you carry this through, this gets into regulators and what's going on and sort of privacy issues, et cetera, around the world. So we're in a completely different ballgame.
I know. It's you put your finger right on it. There's an old saying in Malaysia that sometimes for a research worker in Malaysia, if they want data, they have to get it from the World Bank, because yes, the local authorities who are in charge of that data says it's all secret, it's official secrets. And yes, of course, the World Bank, the IMF has it all. And so if I've got a very good friend with the World Bank, I can get that data, and it really is all these silos that yes, are us making advances in societies.
And it's dated information.
And it's dated information. Correct. Whereas these guys, they have real time.
Correct.
And so they have huge advantages, and maybe that's why their share prices probably reflect that they have huge advantages.
Well, I know this from an equity research report. Facebook looks at 6 to 7 billion pieces of data a day.
Right. Yeah. I know. And we're lucky to get one piece of it. Well, thank you very much, Tad. That was
thank you, Andrew.
Fun. Okay. We'll carry on this conversation.
Okay.